auditors. In our session today, we are going to discuss about verification aspect in which we shall be dealing with the analytical procedures regarding the stocks and also the calculation of various ratios relating to the stock. First of all, the analytical review procedures. Reconciliation of quantities of opening stock, purchases, sales and closing stock, comparison of closing stock with the previous year, comparison of relationship of current year stock quantities with current year sales and purchases with corresponding figures for the previous year. The term analytical procedure actually means calculation of ratios with respect to the relationship that each item in the balance sheet and the financial accounts has with another. For example, the closing stock shall increase as the sales are increased. Hence, there will be a calculation of stock turnover ratio. We have to know over here that when the purchases are added to the opening stock minus the sales, we get the closing stock. And then an average of the opening stock and closing stock calculated with respect to the sales gives us the stock turnover ratio. Now, this will be directly proportional every year, and we have to see that this relationship will be maintained, and as the sales grow up, the stock shall also grow up. Then there is a comparison of composition of closing stock with the corresponding figure of the previous year. Comparison of gross profit ratio and comparison of actual stock, purchases, sales with the budget. Comparison of ratios relating to inventories with industry and with the industry norms. So, the actual figures which are disclosed by the factory will be compared with the industry norms, so that we know whether the factory is growing and the growth rates are being maintained as compared to the industry, whether we are doing fairly well as compared to the industry norms. Next one is the work in progress. The auditor may involve technical expert in verification of work in progress if necessary. He may advise his client that where possible, work in progress should be kept minimum before the closing. Ascertain that the cost sheets are duly attested by the works engineer and works manager. Works in progress means those goods which are not yet finished goods. So, it is not even the raw material, but those goods on which the work is still pending. Hence, the calculation of the cost and also the disclosure in the financial statement is really necessary. For this, the services of the works engineer can be recruited who can ascertain the weightage of the works overhead which will be added to the cost of the raw material and the services that have been rendered. Hence, we shall be able to get at the total rate at which the works in progress has to be disclosed. Test the correctness of the cost as disclosed by the cost records by verification of quantities and cost of materials, wages and other charges in the cost sheet. Compare the unit cost with the standard cost. Ensure that the allocation of overhead expenses has been made on reasonable basis. Compare the cost sheet with that of the previous year. So, there is not only a comparison of this year's figures along with the industry norms, but also the previous year's figures should also be compared, so that we can arrive at a comparison which tells us whether we are progressing towards it will also disclose whether we are progressing and a considerable growth pattern is seen. Now, let us also study the CARO 2003 and inventory requirements. First one is the clause 4.2a, which requires the auditor to comment whether the management has conducted physical verification at reasonable intervals. Clause 4.2b requires the auditor to comment on reasonableness and adequacy of inventory verification process. Clause 4.2c requires the auditor to comment whether the company is maintaining proper records of the inventory. Hence, all these requirements of cost and auditor's report order has to be complied with regard to the inventory. We will be discussing about the goods on consignment. There is a relationship between the consigner and a consignee. A consigner is a person who sends his goods to the consignee, where he will be able to sell out the products, adding his margin and expenses. So, where there are separate account for each consignment which is not maintained, the auditor should make sure that stock sent on consignment and unsold are in closing stock. Secondly, where separate account is maintained, auditor should verify that debit balance in each account represents cost of unsold goods plus proportionate transit and transport expenses. Provision has been made for any damage or loss suffered by the stock. It has to be reiterated over here that until unless the goods have been sold on consignment, the profit element cannot be recognized either in the consignee's account or in the consignor's account. Only the expenses which have been incurred by the consignee shall be entered in his accounts, and when there is a concluded sale, then it shall be recognized both in the accounts of consignor and then the consignee. The next one is the goods on approval. The auditor should ensure that goods sent on approval which are unsold have not been treated as sold, are shown in the account as stock on approval, are valued at lower of cost or market value. Adequate provision has been made in case they are reported to have suffered any damage. Goods on approval means goods sent out on sale or return basis. That means if the customer has taken 3 to 4 items or any number, and with an agreement with the seller that he shall be choosing any of the items or returning if they are not found suitable, appropriate to his needs, then such an agreement is called as goods on approval or an agreement of sale or return basis. So, until unless an indication is received from the customer that he has agreed to keep them, the profit element cannot be recognized. Hence, the goods have to be shown at the value of cost. So, they should not be treated as sold, nor should the profit element be recognized, and they should be included in the stock of the entity. Also, an adequate provision with regard to damages or any other expenses incurred on them should be included. Then are the goods in bond. Where some goods are in bond, it is usual to have separate stock sheets for them. If the goods are pledged with some bank, a certificate should be obtained from the bank. Bonded goods should be valued at cost or market value, whichever is less. So, there could be instances when the goods have been pledged with a bank by way of security in respect of any loan or advances made from the bank. So, these goods should be valued at cost or market value, whichever is less. Contracts in the course of completion. This is not a goods on work in progress, because this term is usually used for the building contracts. So, these are contracts in the course of completion, basically covering the building operations and construction of flats, housing societies, etc. So, in the field of building construction, a contract may extend over 2 or more years. In those cases, it is necessary to value the work in progress at the end of each year. It is advisable to prepare cost statements and on that basis compute value of work in progress at the cost plus part of profit attributable thereto. In the case of goods produced against a forward contract which are ready for delivery, the same should be valued at price less the delivery expenses. So, this particular kind of accounting and valuation for the building operations is done because these contracts are carried from year to year, usually when the span extends for more than a year. Hence, it is always advisable to prepare the cost statements so that we can have a reasonable basis to arrive at their cost. Also, in the case of goods which are produced against a forward contract which is based on future, which are ready for delivery, the same should be valued at price less the delivery expenses which could be incurred by the entity. The next one is the book debts. Verification of debtors may be carried out by employing the following procedures: examination of records, direct confirmation procedure, analytical review procedure. The book debts are the debtors which are created in the due course of business by the entity. These people have not paid on cash, hence they are recognized as book debts. Now, how to examine the records? The auditor should examine the relevant records for validity, accuracy and recoverability. Bad debts written off or excessive discounts should be verified with the relevant correspondence. Auditors should also check agreement of balances as shown in schedule with the ledger. Now, basically it has to be recognized over here that book debts which are depicted by the financial statements may not be actually recoverable. Hence, an examination which should be done deeply should be made, and then it should be safely arrived at what is realizable. For this, an aging schedule of the debtors should be made, and book debts which have been irrecoverable for the say past 3 months, 6 months, for a year, for 2 quarters, 3 quarters, etc., whichever reasonable basis is arrived by the entity should be made. This aging schedule should also be checked by the auditor and see whether the provisions regarding to bad debts is being made in an appropriate manner. The auditor should examine the age of the debtor which has been properly determined, whether transfers from one account to another are proper, whether provision for allowances. Bad debts should recognize that even though debtor may have confirmed the balance, he may still not pay. Book debts examination of records. The following are some indications of doubtful debts. The first one being terms of credit have been repeatedly ignored. Usually whenever the credit is given to a debtor, it is given on a credit of say 15 days or 30 days. If the debtor is a defaulter and he has done this default repeatedly, then it will indicate that it is a doubtful debt. Secondly, there is a stagnation in the account. That means there is no activity occurring in that account. There are no purchases and no creation of more debits. Then is payments are being received but the balance continuously increasing, which means payments are received in very small amounts, but the credit sales are in a lump sum. Hence, the balance will grow continuously. And the fourth one is the checks received have been repeatedly dishonored. This shows a cash tight position with the debtors in which the checks are being repeatedly dishonored and he has to issue fresh checks. Another one is debt is under litigation, arbitration or dispute. When the amount which is being asked by the entity is under a dispute with the debtor, then the debt becomes doubtful. The auditor becomes aware of unwillingness or inability of the debtor to pay. If the debtor is in cash strapped position or there is a doubt of insolvency of the debtor, then the auditor will become aware of the unwillingness or inability of the debtor to pay. Collection is barred by statute of limitation. That means a limitation period in which the debt could be recovered, that is 2 years or 3 years depending on the kind of account it is. That period has already expired and no amount can be recovered from the debts. So, for these debts it should be written off as soon as this information is received that it is barred by the law of limitation. In case of claims against the insurance companies, the auditor should examine correspondence or other available evidence to ascertain that the debt is acknowledged and there is reasonable possibility of realization. Book debts, the direct confirmation procedure. The direct confirmation procedure means when the auditor directly sends advices to the debtors to confirm the balance with the entity. that is his client. So, in that case the debtors prepare their own schedule, the copy of their accounts, and send it over to the auditor so that he can cross verify it with the records that are shown in the entity. The verification of balances by direct communication with the debtors is theoretically the best method of ascertaining whether balances are genuine and accurately stated. The auditor employs direct confirmation procedure with the consent of the entity. Auditor decides the confirmation date, method of request, and particulars to be obtained from the debtor. Where the number of debtors is small, all of them may be circularized, but if the debtors are numerous, this may be done on sample basis. The method of selection of debtors to be circularized should not be revealed to the entity until the trial balance is handed to the auditor. Any discrepancies should be asked to be investigated and reconciled. Hence, a selective method can be employed by the auditor in case there are numerous small accounts of debtors with the entity. He can use materiality as the selection criteria. Only those accounts which are big and have too many balances, on a selective basis the auditor can go for the direct confirmation in those accounts. Now, for the book debts, the analytical review procedure. Comparison of closing balance of debtors, loans and advances with the previous year. Comparison of relationship between current year debtor balance and sales. Comparison of actual closing balances of debtors, loans and advances with budget. Comparison of current year aging schedule with the previous year. Comparison of significant ratios relating to debtor with the other firms in the industry and also with the industry norms. Like we had discussed about the analytical procedures to be followed with the stock, that is comparing the closing stock and the opening stock with the turnover, that is sales. The same way we have to compare the opening balances of the debtors, the closing balances of the debtors, and compare it with the turnover. Again, here it is to be reinstated that more the sales, more will be the creation of debtors. Hence, if there are more sales, we have to find out whether the same kind of relationship is being maintained from year to year. Also, the entity ratios should be compared with the industry norms also. Now, how the book debts have to be disclosed? The disclosure requirements will involve that the auditor should satisfy himself that debtors have been disclosed properly in the financial statement. Relevant statutory requirements should also be met. Debtors are required to be classified as under debts considered good and secured, debts considered good but for which company holds no security, debts considered doubtful and bad. After deciding upon the criteria on which we have to disclose the debts, this will be involving bifurcation into three types, that is debts which are good and secure. These are those debtors which pay on time and also respect the credit facility which is being given to them. Secondly, the debts which are considered good but for which company holds no security. These are those debts for which some risk is involved. And thirdly, the debts which are considered doubtful and bad. These are those debtors which have not paid on time and have been pending, and their balances are growing with quarter to quarter. In addition to the disclosure is also required of the debts which are due by directors or other officers. Debts due from other company deemed to be under the same management have to be disclosed along with the name of the company. There has to be a separate disclosure regarding the debts which are owed by the directors or the other officers, because the Companies Act requires a separate disclosure because it becomes a material item, and hence they should be disclosed in a separate manner. Also, the debts which are due from other companies which are deemed to be under the same management have to be disclosed along with the name of the company. Now we shall discuss the debts requiring special consideration. The debts in the foreign currency. After conversion, whether it is more or less than the amount which is shown as recoverable, deficiency or appreciation thereof should be appropriately adjusted in P&L account. Package and empties. Provision should be made in case of packages are returnable but customer has not deposited any security. Now over here, when the debts are recoverable in the foreign currency, it is to be noticed here that there is a difference between the creation date of the debt and the realization date of the debt, and also the date of the financial statement, that is 31st March. Hence, there will always be a difference when there is a conversion of the debt into the foreign currency. This difference has to be shown whether it is the amount which is recoverable, and also if there is any deficiency or appreciation, this amount should be properly adjusted in the P&L account. Regarding the packages and empties, consider the case of LPG gas cylinder in which the gas cylinders are delivered along with the gas, but the customer is charged only for the amount which he uses as gas, and the cylinders are returnable. But what will happen if these returnable packages, an adequate provision has not been made thereof? So it should be seen that provision is made in case these cylinders or these packages or empties are not returned by the customer. The next one is the hire purchase debt. The auditor should confirm that the installments which had accrued have been realized. In case of areas and articles still in possession of hirer, necessary provision for loss on anticipated sale of asset should be made. Hire purchase are those agreements in which the ownership does not pass until unless the last installment has been paid by the hirer. So in that case, the auditor should confirm that the installments which have accrued have been actually realized. Also, it should be seen that in case the last installment has already been paid, then the same should not be shown as a liability in the balance sheet, and it should be recognized as a full asset in the entity's account. Also, in the case of areas and the article is still in possession of the hirer, necessary provision for loss on anticipated sale of asset should also be made. With this, we are concluding our today's session. In this session today, we discussed about the analytical review procedure. The discussion revolved around the analytical procedures which can be applied to the calculation of stock turnover ratios, the debtors turnover ratio. Also, we discussed about the procedure to be followed in the work in progress. Also, the work in progress created in the building operations. Also, we discussed about the hire purchase agreements. And also we discussed about the auditor's responsibility regarding the disclosure of the value of the stock and the debtors and the aging schedule required to be made by the entity. I hope you enjoyed the session. Thank you.